Stop what you're doing. If you own or follow consumer food stacks, you absolutely need to see this breakdown. Last week, I ran the Marzetti company's Q3 2026 numbers, and honestly, what I found was pretty wild. We're looking at a literal financial paradox today. Imagine this. Consumer demand is shrinking, revenue is slipping, and yet, somehow, they are posting record-breaking gross profits. How is that mathematically possible? Today, we're tearing apart Marzetti's Q3 data and their massive $400 million acquisition. By the end of this explainer, you're going to know exactly if this high-stakes pivot is a brilliant move or a dangerous trap. Let's dive in. Right out of the gate, we've got a number that would make any investor sweat. Net income for the quarter contracted by a severe 9.9%, dropping down to $37.1 million. When you see bottom-line earnings take a near double-digit hit like that, yeah, it signals massive pressure. Consumer demand is decelerating, and it's eating right into their overall profitability. But here's the crazy twist. Right alongside that severe drop, management somehow squeezed out a record third-quarter gross profit of $107.2 million. That's up 1.2% year over year. Seriously, ask yourself, how do you pull off record structural profitability when your actual sales volume is falling? Well, here is our agenda to solve this mystery. 1. Rebranding to the Marzetti Company. 2. The Q3 profit paradox. 3. Retail drop versus food service stability. 4. SG&A bloat erodes margins. 5. The $400 million Butchins catalyst. And 6. Q4 outlook and innovation pipeline.
Section 1. Rebranding to the Marzetti Company, a new identity.
So in July 2025, Lancaster Colony Corporation officially rebranded as the Marzetti Company, now trading under the new ticker MZTI. And this wasn't just a cosmetic paint job. It signaled a major modernization of their portfolio. For decades, they went by their legacy name, but shifting to Marzetti puts their strongest, most consumer-recognized brand right front and center, especially as they attempt to pivot hard toward premium flavor categories. Moving to Section 2. The Q3 profit paradox, efficiencies versus reality. This table perfectly captures the contradiction we've been talking about. Look at this. Total consolidated net sales fell 1%, and earnings per share dropped 9.4%. Yet, structural cost savings and supply chain optimizations, like fully integrating their Atlanta facility, pushed gross profit up to a record $107.2 million. Basically, their operations are getting much leaner, expanding gross margins by 50 basis points, or 0.5%, even as fewer actual products go out the door. Section 3. Retail drop versus food service stability. A tale of two segments. To really understand the top-line revenue decline, we have to look at their largest division, retail. They suffered a steep 5.6% volume drop, and that is measured in actual pounds shipped, folks. Revenue here declined 3.2%. Management is explicitly pointing the finger at macroeconomic category softness. It basically comes down to price fatigue, tightened household budgets, inflation, and folks buying way less in bulk at warehouse clubs like Costco or Sam's Club are seriously shrinking grocery basket sizes. Consumers are just passing on those premium peripheral food items right now. But conversely, their food service core accounts provided a massive, much-needed anchor. This segment actually posted a 1.8% sales increase to $218.1 million, with positive volume growth. In a really tough restaurant environment, this proves just how durable their strategy is to align with top-performing national chains. Supplying 17 of the top 30 national restaurant chains is literally what is saving their top line from a much steeper drop. All right, Section 4. SG&A bloat erodes margins, the missing profits. Now check out the glaring discrepancy on the far right side of this chart. SG&A, or selling, general, and administrative expenses, rocketed up nearly 10% against a 1% decline in revenue. This right here is the missing puzzle piece. This massive spike in corporate spending is exactly what absorbed all those hard-won factory floor efficiencies we just praised. So aggressive corporate spending basically wiped out those supply chain wins. Total SG&A hit $61.4 million. Now, to be fair, $3.5 million of that was directly for M&A-related costs. But the rest, that reflects heavy underlying investments in personnel and a huge transition to a new enterprise IT system, SAP S/4HANA. Management is essentially betting that paying for this highly scalable IT infrastructure today is absolutely crucial for tomorrow's growth, even if it's completely punishing the current quarter's bottom line.
Which brings us to Section 5, the $400 million Botchins Catalyst, a high-margin pivot.
This situation creates a really stark bull versus bear dynamic for anyone analyzing the stock right now. On one hand, you have to weigh their incredible margin resilience and massive M&A upside against the immediate retail volume contraction and the corporate bloat we just unpacked. It is a true crossroads for the entire business. The absolute cornerstone of the bull case here is the May 1st closure of their $400 million acquisition of Botchins. If you haven't heard of them, they're a fast-growing, premium Japanese barbecue sauce brand that had already scaled to nearly $87 million in recent annual sales. Marzetti used cash on hand, plus a new $200 million term loan to pull this off, entirely expecting Botchins to inject high-margin growth straight into the top line starting in Q4. And here is exactly how they plan to make that $400 million price tag pay off. Marzetti is going to immediately transition Botchins into their optimized internal supply chain. Up until now, Botchins has been entirely co-packed by third parties. Marzetti is going to move all that production in-house, specifically leveraging those efficiencies from modernized facilities like their Atlanta plant to extract massive synergies and seriously boost profitability. Finally, Section 6, Q4 Outlook and Innovation Pipeline, sparking organic demand. So, to get out of this retail slump, their strategy relies on shifting focus slightly away from legacy, carb-heavy bakery brands. For example, they actually just exited a very low-margin breadstick business just to protect their profitability. Instead, they're pivoting hard toward highly profitable, premium, authentic flavor additions. The market is demanding specialized sauces and dips right now, and Marzetti is realigning their whole portfolio to meet it. To execute this, they're rolling out a highly targeted Q4 innovation pipeline. They are banking on exciting new products like Marzetti Protein Ranch, new veggie dips, and Olive Garden zesty Italian flavor, and expanding into larger formats for crazy popular items like the Chick-fil-A avocado lime ranch dressing. They're really hoping these innovations will aggressively stimulate consumer demand and get that retail volume flowing again. So ultimately, it all comes down to this single, crucial question. Will the $400 million Botchins injection, paired with this brand new product pipeline, be enough to overcome a tight, inflation-weary macroeconomic environment? They built an incredibly efficient supply chain and a modernized IT infrastructure. Now, they just need the consumer to show up. Thanks for joining me on this explainer, and I'll leave you to ponder that vital question as we watch Marzetti's Q4 unfold.